Hi YouTube, Regina here from Simply Fundamental. So today I wanted to talk to you about debt to income ratio and how you can use it. Yesterday I spoke about how I had a car payment and how I had my rent was really took a vast majority of my budget, but I didn't actually do the calculation just to try to explain how much of my income actually went towards debt. And debt to income ratio, when you use it with your net income, shows you how much of your income is actually going towards debt. And anything below a certain percentage, well, you really want it to be below 35%, would be okay. And anything above that, you're getting into territory that is considered really bad, for you financially. So, wanted to talk about showing you how to do a net debt to income ratio. So when you use your spendable income, yeah, it's probably the better way to do it. So banks use debt to income ratio to determine how much of a loan you can afford. And then they'll have a range for that loan. So the range is because of the high end of the debt that they perceive that you can have, and then the lower end of the range would be the lower end of the debt. So that's why there's always a range when it comes to mortgages. So it would be based on, sometimes they do it based on gross, and other times they do it based on net, or I do it based on net. And the reason why they do it based on gross is because, some people put money in their retirement, some people can change their tax deductions, whether or not they have kids. So they do it based on overall, generally from gross income, and that is before it is taxed. And so what you do is you take all your debts and then you multiply, and then it would be divided by your gross income for the year, and then you would multiply that by 100. So or you can do it as far as even on a monthly range. So, but it would still be giving you the same percentage. So, for example, as a calculation, let's say you have a net monthly income of $5,000. So, this is the debt to income ratio. This is going to be your total debts divided by net income. Okay. And let's just say you have net income of a month of $5,000. $5,000 is your net income. After you pay all your taxes and everything, that's what you're going to net. And let's just say you you have a mortgage of 1,200. You have a auto loan of 300, and you have credit cards, the minimums on them, and that would be 100. So I did a scenario here. That would bring you to 1,600 a month. So I'm going to do 16. You would then take the 1,600 divided by the 5,000, and then you're going to multiply it by 100. And the only reason why you do that is to move over the two zeros. And so that would then give you a calculation of 0.32 multiplied by 100, and that would be 32% for that. That would be your debt to income as far as all your debts. Now, 32% isn't bad, but you could see these numbers are pretty low. And so if you want to figure out how much where you fall out, just look at what you take home at the end, what you take home for at the end of the month, and all your, take home pay, and that would be your net. And then you multiply, I'm sorry, you add up all your debts, and then you just divide it by it, and so you would get the percentage. So another reason why to use this is if you're trying to figure out and calculate whether or not you can afford a car, whether or not your ratios on your bills are going to be fine. So we've talked about it before, where your ratio should be 30 I'm sorry, 50, we talk about the 50, 30, 20 rule, and 50% on needs, 30% on wants, and 20% on savings. Now, I think these two should be switched around, especially if you're starting out now and it's later in life and you haven't saved anything. You should definitely try to aim to at least swap those two and do the 20% on wants versus the 20% on savings. But in this 50%, now it's not, it's almost unrealistic if you're starting out and you're not in a very good position. But generally, what you do is you're going to take that same $5,000 income and then you're going to multiply it by 0.50, and that's going to be 2,500, and that's going to be all your needs. And then you're going to take the 30, and that is going to, of the 5,000, and that's going to give you, what is 30% of? Just give me a second. 1,500. And then the 20, probably should have done that easily. And that's going to give you 1,000. So you either spend 1,000 on your wants, or you use that as savings. So really the 50, 30, 20 is all your needs fit in the 50%. And so this obviously makes up 100%. So 50, 30, and 20 is 100%. And so 100% of your net would be split this way. So if your net were 5,000, all your bills, this would be your mortgage, your property taxes, this would be like your car insurance, your car payment, your groceries. So all your needs would fit in the 50%. And then things like your wants would be going out to dinner. Sometimes people go over on their needs a little bit and it bleeds into their wants. So if you end up getting a car payment that's a little bit too high for your um, needs category, it would then bleed over into your wants. So um, wants are things for like non-essentials, like dining out, anything you want to do. Let's say you want to go away on vacation, or like any hobbies you might have. And then you also want to try to, when it comes to payments on cars, which I didn't do, I didn't know this when I was first starting out, is for cars, you want to try to do the keep your car payment no more and of the total 50%. So the car would go into this 15%, but that includes car insurance as well. So as far as when you're trying to figure out how much you can spend on a car, you're going to use that as a guideline so that you can see, hey, I'm trying to figure out if I could, how much I can afford on a car. So they say the car should be 20, 4, and then 10. So on what you can afford for a car. So let's say you would take 20% down for your loan and 10% of your annual income of what you can afford for a car. So that's the rule which you want to try to fit in. So you know what you make a year, and then you want to try to make sure that you're spending no more than 10% of your income. So in the case of myself as an example, when I was making $28,000 a year, I couldn't afford a $271 a month car payment because my car should have just cost me 2,800. I should have stayed under the 10% rule for the 2,800. Now, when it comes to the car payment approach, if your net income was 5,000, again using that as an example, that would mean multiply that by the 15, and that would give you $750 to pay on all your car expenses for the month. So that would give you 15, but then that would lower this to 35%. So 35% of your needs would then. So if your home costs 35% of your take home, so that would leave you 1,750. And if your rent was 1750, then you're obviously going over. You reached the max of the 750 and the 1750, and you went over the 15%. To remember, the 50% is 2500. So in the case of myself, as an example, when my rent was $650, but my take-home pay was only 700%. That I believe is like I was up in the 90s, so 650 divided by, yeah, 92.8%. So 92.85 multiplied by 100, so it's like 90, almost 93%. Multiply that by 100, and that's 93%. That was what my take home was as far as my rent. So clearly not in the 50% range when I was starting out. I needed to get a second job. And now, as far as the car payment, this 750 would tell you all you can afford. So that 750, sometimes what dealers will do is they will say, how much can you afford on a car? And they'll just drag out the loan period to more years. But then that wouldn't apply to the 24/10 rule. And that 24/10 rule is sort of like a margin of safety so that you know what you can afford. You should try to keep the car within 10% of your gross income, and then 20 would be putting 20% down so that you can reduce the amount of loan and fit within the 4-year time frame of what the loan you could afford. And assuming you're doing those things, you'll probably fall in a decent range unless you have a really high credit risk, or you have lots of outstanding debts, or your debt to income ratio is extremely high. So when they're looking at loans and your loan worthiness and whether your credit worthiness, it really is going to depend on how much loans you have outstanding. So that's another reason why I was able to get a car payment for $399 when I was first starting out, because I didn't have a home, and I didn't have any other, debts that took up that 36% of my budget. But then they gave me the high end of the probably what my income was at the time, giving me a car that fit within that budget of the equivalent of what today is. I think $399 at 1989 is the equivalent of $963 a month today. So vast big difference to be able to afford a car. So this is some of the things that I was talking about yesterday, and just wanted to go through them as far as you use these numbers to try to figure out what you can afford, as far as how much your debts you have, whether or not you should, if you can afford a loan, how much of the loan it should be, whether or not even looking for like someplace to start out with your budget on how to work out the numbers that should work out, so that you'd say, geez, I'm making $5,000 a month, no more than 50% of my money should be split between all the needs categories. So you use it as sort of like a pre-budgeting tool. And then that debt to income ratio, the DTI, it also works the same way when it comes to savings, but it's just it's a savings rate, savings to income, right, ratio. So the STI, and that is you take the amount that you're saving and you do the calculations. And so for in that case, if you were saving, let's do this, you're still making $5,000, but if you were saving 1,000 divided by the 5,000 and then multiply it by 100, right? So that would give you the 0.20, and then multiplying that, you're saving the 20%. So that would be that calculation. But if you're only saving, let's say you were only saving 500 divided by the 5,000 net that you netted a month, now you're obviously only saving 10, multiply that by the 100, and that's 10%. That gives you 10%. Sorry about that. That gives you the 10%. So you can use that to see your savings rate. And then the interesting aspect about the savings rate is the more that you're saving, the quicker you are, especially if you're going to apply something like the 4% rule on the amount that you're saving. That's going to have to sustain you later on in life. So you want to try to get your savings rate, especially to be high if you haven't saved any money yet. And if you want to try to get ahead and you don't have any emergency fund and you need the money to be able to pay off debt. So the saving category should be used for debt repayments as well. Sometimes people use debt repayments in their needs category. It's but it doesn't fall into needs. Your debt repayment really falls in within the wants and the savings category. So if you really have high debt, then you have to take from the wants category. And that may mean you're just spending a lot less. And so instead of spending, $1,500 on wants, you swipe it around. Maybe you take the 20% that you're supposed to on savings and change that into be the wants category. Because you have to live your life. You have to spend some money. You can't just be a miser. You may be able to do it for a short time, but it's not something that you should do for a sustainable long period. And I do believe that if you're in such dire straits and you're living too close to the edge, then saving should be a priority over the wants. But there should never come to a point where you're not spending anything on any kind of fun, because that would just be a, that would make it very unsustainable for even any period of time. So you should try to at least make sure that you're spending 5%, minimum at least on fun money, on maybe going out or meeting with friends. If you can't do the 20% because you have too much debts, and then as your income grows, you can spend a lot more on these categories. But I do believe in shifting the categories, and the the more you can get your needs category down. So your needs doesn't necessarily have to be the 50%, but that's a starting point. A lot of people are spending much more than that. And as you get raises and as your income starts to grow, you can that's where you have to worry about increasing your lifestyle inflation, because people will keep their needs within the 50% category, saying, well, I can increase my life now because I'm making a lot more money. But it's more advantageous to take that extra money and do it instead, spend your money instead on making sure that you're growing your wealth, so that you eventually have a point where your savings, that you are able to invest those savings to then turn into creating an income for you that completely covers your needs. And the lower your needs category could be, the more easier it is to sustain your life. Anyway, just wanted to go through these different financial, tools around debt to income ratio, how it is used. A high debt to income ratio is considered like 40%. And in that area, it would be in your over leverage. So a lot of times, if you didn't have a home and you then go buy a home at the high end of what they think, they're including all your debt to income ratio. And so if you don't have any credit card debt, you'll qualify more for a home. But then as you're starting to buy things, that's where people get in trouble, because then they're adding debts, and then it raises their debt to income ratio. And then with your savings to income ratio, you definitely want it to be at least 20% or more, so that you could get to a point in your life where you are replacing your job with your own income, with your income that you make on investing. So good to know those formulas. They're practical to use in real life. And as far as using them when you're thinking about buying a car or buying a home, you want to then take these ratios and say, geez, how much can I really afford on a mortgage? How much car debt do I have? Is what the lender is suggesting that I can afford? Does it fit within is it below that 35% between all my debts that I would be carrying? And then how would these categories change my overall net income? And if you're a dual income household, then you would just take both your incomes and use that to see how would it fit within both incomes, and you would find your debt to income ratio as a couple and then use that to try to make sure that you're staying within a margin of safety so that you're not living above your means and you're able to save, invest, and grow your wealth. Anyway, this is Regina from Simply Fundamental. I hope this video was helpful. I thought when I did yesterday's video, sometimes when I do these videos late in the day, I'm a bit tired and I don't get all my thoughts out, or I stop mid sentence and I think I'm saying what I mean to say, and sometimes it doesn't come out the way that I was trying to make it across. And so yesterday I put a video out. I do think that there are times where people end up living a life that is paycheck to paycheck, and it's because their debt to income ratio has gotten to an unsustainable level. And so that's why I wanted to pick up today and talk about your debt to income ratio. And in the case of my car payment, and in the case of me renting on my own, my debt to income ratio was almost 93%, and clearly most of my paycheck going just to pay rent meant I couldn't afford to live alone. And so that's a harsh reality. Sometimes you use these numbers to figure things out, even though you're going to figure them out just because, you're struggling to make ends meet, and you run out of money before the end of the month. And so helpful to know how to use them. And if you have any questions, hit me up in the comment section. And thanks for tuning in, and I will catch you on the next one. Take care.